You worked all month, got paid, and somehow most of your money disappeared. No one explained why. No one showed you how the system really works. But today, you're about to understand everything. Step 1. Taxes and the real world. Taxes. Picture this. You just survived a brutal month working long shifts, grinding non-stop at your local fast food spot. Exhausted, you finally crash into bed. Then your phone lights up. A message from work. You've been paid $2,000. Sounds great until you check your bank account. $1,456. Just like that, hundreds disappeared. You scroll down and see the breakdown. Federal tax, state tax, Social Security, Medicare. It feels like invisible hands quietly taking their cut. And somehow you're expected to accept it. Here's the truth. Taxes are the price of living in a functioning society. You contribute, and in return, systems are built around you. Roads you drive on, schools that educate people, safety regulations that keep businesses clean, and yes, things you'll probably never see. But not all taxes are the same. Income tax hits what you earn. Sales tax hits what you spend. Capital gains tax hits what your money earns without you doing anything. No matter what you do, a piece of every dollar moves away from you. Then there's Social Security. It's forced saving for your future. You give now and receive later. Medicare works differently. It supports health care, especially for older people or those in need. Now comes the frustrating part, filing taxes. The system already knows what you owe, but still makes you calculate it yourself. If you get it right, nothing happens. If you get it wrong, problems start. Some people pay throughout the year, others pay once, and some avoid it completely until consequences catch up. But here's the perspective shift. Taxes may feel painful, but they fund stability. In many places, higher taxes often connect to better living standards. So yes, it stings, but it's part of the system we all live in. Before we go deeper into money, make sure you subscribe to Rich Mind Finance, hit the notification bell, and stay ahead, because understanding money changes everything. Step 2. Banks and how your money moves. Banks. You walk in, deposit your money, and leave feeling secure. It feels like your cash is sitting somewhere safe, locked away, untouched. But that's not what's happening. The moment you deposit money, it doesn't just sit there. It starts moving. Most people think banks store money. In reality, they circulate it. They act as the bridge between people who have money and people who need it. Let's say you deposit $1,000. The bank doesn't keep all of it. They keep a small portion and lend it the rest to someone else. Maybe that person wants to start a business. Maybe they want to buy something big. This system is called fractional reserve banking, and it works because not everyone withdraws their money at the same time. But if everyone did, that's when problems happen. History has shown this before. When people panic and rush to withdraw everything, systems can collapse. So, how do banks make money? Simple. They pay you a small amount to store your money, then they lend it out at a higher rate. That difference is their profit. You are the supplier of money, borrowers are the demand, and banks sit right in the middle. But banks still offer value. They make spending easier. They allow fast transfers. They reduce the risk of losing your money physically. And in many places, deposits are protected up to a certain limit, meaning even if something goes wrong, your money is still backed. So while it may feel like your money is just sitting, it's actually working behind the scenes, quietly moving through the system. Step 3. Interest and how money multiplies. Interest. This is where money behaves differently. Imagine borrowing $1,000. Later, you repay $1,280. That extra amount, that's interest. It's the cost of using someone else's money. When you borrow, interest works against you. When you save or invest, it works for you. There are two main types. Simple interest is straightforward, a fixed cost added over time. But compound interest, that's where things change. It means your money earns returns, and those returns start earning more returns. It stacks, grows, builds momentum. Think about a credit card. You miss a payment. Now interest builds on your balance. Then more interest builds on that interest. What started small becomes overwhelming. But flip the situation. Invest your money. Let it grow at a steady rate. Now your gains begin creating more gains. Over time, the growth becomes powerful. Not fast at first, but consistent. And consistency wins. This is why interest is so important. It can quietly build wealth or slowly create debt. So what's the strategy? If you owe interest, reduce it quickly. If you earn interest, let it grow. Give it time. Feed it regularly and don't interrupt it, because interest doesn't need attention. It just needs patience. Step 4. Inflation, recessions, and credit. Inflation. You buy something today. Next time, it costs more. Same product, higher price. That's inflation. It's the gradual loss of money's purchasing power. Your money doesn't shrink physically, but its value does. Over time, it buys less. Why does this happen? Sometimes demand increases. More people want the same things. Prices rise. Other times, production becomes more expensive. Costs increase, so prices adjust. And sometimes, people expect prices to rise, so they spend faster, which pushes prices even higher. A cycle forms. Small inflation is normal, but when it spikes, problems begin. Savings lose strength. Costs rise faster than income. To control this, interest rates increase. Borrowing becomes expensive. Spending slows. The economy cools. Then there are recessions, periods where economic activity drops. Jobs disappear, spending decreases, businesses struggle. It feels like everything slows at once. But recessions are part of the cycle. They reset the system. Painful, but temporary. And then there's your credit score, a number that represents trust. It shows lenders how reliable you are, not how rich you are, how consistent you are. Do you pay on time? Do you manage your limits? Do you handle credit responsibly? All of this builds your score. A strong score opens doors. A weak one closes them. So manage it carefully, because in the financial world, trust matters. Step 5. Money, investing, and time. Money. At its core, it's based on belief. Paper has value because people agree it does. That's what gives currency power. Without trust, it's just paper. But with trust, it moves the world. And to protect its value, you need to invest, because money sitting still loses strength over time. Investing is what puts your money to work. Instead of trading time for income, you let money generate more money. There are different ways to do it. Stocks give you ownership in companies. Bonds allow you to lend money and earn interest. Funds spread risk across multiple investments. Real estate creates long-term income potential. Each comes with risk, but also opportunity. The key isn't luck, it's patience, consistency, and time. Because time is the real advantage. The longer money stays invested, the more it grows. Slow at first, then faster, until the results become significant. That's how wealth is built. Not overnight, but over years, even decades. So start early, stay consistent, and let time do the heavy lifting. If you've made it this far, subscribe to Rich Mind Finance, hit the notification bell, and keep learning. Because the more you understand money, the more control you gain. And that control can change your entire future.